Welcome to part 2 of how the MERS charade means reduced principal and lower payments for you. In part 1, we learned that the banks used MERS to track the sale of mortgages in the secondary market, helping them avoid the cost and hassle of filing assignments at the county recorder's office. We also learned that this had the effect of hiding the sale from the borrower, which is illegal. In part 2, I'll tell you why this is illegal and how it could lead to a principal reduction on your loan. Courts across the country have ruled that using MERS is illegal. You see, the law states that maintaining a proper chain of ownership for loans secured by real property is a vital and important necessity. But lenders used MERS to completely bypass this requirement, creating the MERS charade. Lenders thought they could appoint MERS as their nominee, and if a homeowner defaulted on their loan, MERS would be the foreclosing authority. But here's where the MERS charade breaks down. Because MERS is only the nominee, MERS doesn't actually own the loan, and legally, only the actual owner of the loan can foreclose. It's as simple as that. Well, what does this mean for the homeowner? Well, because the originating lender doesn't own the loan, and MERS doesn't own the loan, neither of them can foreclose. And the loans have been sliced and diced so much through securitization that it's impossible to piece the actual ownership of the loan together. This means that if you default, no one can foreclose on you. Your loan is no longer secured by your home, and it cannot be taken away from you through foreclosure. Lenders' realization of their mistake and the dire consequences it presents have made them more willing to negotiate principal reductions. Without legal standing to foreclose, lenders would rather have you making payments on a smaller loan than filing a lawsuit to dismiss the original loan. Also, lenders do not want this situation to become widely known because that would only increase the number of principal reductions they'll have to make. The bottom line is that if your loan was registered in MERS, your lender likely sold your loan and has no legal standing to foreclose on you. They'll therefore be very willing to negotiate a principal reduction. Court cases across the country have established the precedent. If you have a MERS registered loan, you stand a very good chance of receiving a principal reduction on your loan. So how do you find out if you can get a MERS principal reduction? The only requirement is that your loan must have been registered in MERS. You can use our easy MERS loan registration check on our website. Just fill out the form and you'll know within 24 to 48 hours if you're a candidate for a MERS principal reduction. There's no cost to find out and there's no obligation whatsoever. You can click the button below or look for this button anywhere on our website. That's the end of part 2 of how the MERS charade means reduced principal and lower payments for you. Thank you for your time, and remember to click the button below or find it elsewhere on our website to find out if your loan is registered in MERS and whether you might be a candidate for a principal reduction.